Hi, good morning, everyone. Thanks for joining us this morning for our weekly morning call. For stock counter updates, we have TDCX's results as well as a Phillip on the ground on Pasture Holdings. And for the macro sector outlook, we have the FAANGM monthly and the banking monthly, as well as our usual Singapore weekly. So without further ado, I'll hand it over to John for TDCX. Thank you.
Thanks, Ben. Good morning, everyone. So I'll just begin with TDCX's first quarter 2023 results. Next slide, please. Okay, so TDCX's first quarter results were roughly in line with our expectations. Revenue and PATMI came in at 23% and 25% of our full year forecast. In terms of what did well, so TDCX, just for some background, they're actually a outsourced customer experience company. So they have two main, I guess, revenue channels. One would be your omni-channel CX, and I guess you can think about that as like a call center in a way, where they deal with complex problems, not just like, help me change my password, but more like, for example, if you need to change a flight or your flight is delayed or something like that, then they kind of provide those kind of solutions. Or if you have any tech issues for any tech hardware, they also do that. The second main, I guess, segment for revenue would be sales and digital marketing, which is SDM. So they help companies with their sales and digital marketing campaigns to drive increasing efficiency. So in terms of what did well, they continue to diversify their revenue mix. So not too long ago, TDCX actually relied quite heavily on it's a handful of big clients, and this was a little bit of a risk because if you got all your revenue concentrated in these clients, right? So if anything happens to any one of these customers, for example, they start pulling back on their spending, or they want to downsize their contracts, then it would really significantly impact revenue growth. But so what we're seeing right now is that revenue from outside of the top 5 clients actually grew from about 17% last year in the first quarter to about 24% this year. So it got this, it continued to diversify a little bit. Revenue growth was actually 45% year on year from clients that were outside the top 5 biggest clients. And this is quite interesting because they've recently been expanding into a lot of newer geographies, starting in 2021. So the newer geographies that they actually went to in 2021, namely South Korea, Colombia, and Romania, actually are starting to show some meaningful revenue contribution. Revenue grew actually 4 times year on year from the first quarter last year to the first quarter this year. Secondly, along with a lot of other tech companies, TDCX is also starting to leverage on AI for their growth. They recently launched this program called TDCX AI, which is a new consulting division. So what this division is supposed to be for is to leverage on AI's insights and tools to deliver highly personalized and complex CX solutions for its clients at a faster pace than usual. And this is important because a lot of the demands from their clients are getting more and more complex. Their clients need to solve more and more complex issues, and they rely on TDCX to do so. At the same time, TDCX is also investing in generative AI tools for improved operational efficiency. The main knock on earnings for this quarter was that adjusted EBITDA margins are actually down about 7% year on year to 24%. The main reason for this is that as they expand into outer geographies, the startup costs, as they expand geographies, the startup costs in these places is a little bit high when you're ramping up. And at the same time, the places that they've expanded into last year right now are growing, and so they need to kind of just increase their general overhead costs, hiring and training new staff to be able to ramp up their services. So in the near term, it is kind of a negative, but in the long term, we view this as something that is fundamentally positive because the company needs to expand into new geographies to actually grow the company, and it positions themselves quite well in the future because when we expand to other geographies, you have firstly you get a wider range of linguistic capabilities, so you're able to serve more markets and I guess sell cross-border services. And secondly, once you actually set up an office in a country, for example, it's easier to ramp up future campaigns from clients that may not have a presence there, but want to set up a presence there. So moving into outlook, the TDCX actually reiterated its fiscal year 2023 revenue growth range about 3 to 8% in constant currency, which is a little bit surprising because revenue grew at about 13% in FX neutral for the first quarter. So it is a little bit below how they performed in the first quarter. They did mention that there were longer sales cycles and also a continued lack of visibility for the rest of the year, especially with such macroeconomic uncertainty still looming in the backdrop. In terms of their EBITDA margin outlook, they also maintained this, and we do think it is down a little bit from last year, but it's kind of expected because they continue to expand into newer geographies. Overall, we still actually keep our target price unchanged at $12.10, but we actually upgrade to a buy, mainly based on recent share price performance. So that's it for TDCX. I'll move on to FAANGM Monthly. So just a snapshot for the FAANGM in May. The FAANGM was up about 8.6%, so they outperformed both the Nasdaq and the S&P 500. S&P 500 was relatively flat, while the Nasdaq gained about 7.6%. Netflix was the top gainer. They were up about 20%, mainly due to some positive news on their ad-supported plans, while Apple was the main laggard, but was still up about 4% for the month. We still continue to see near-term weakness in demand for tech consumer goods, digital advertising, as well as cloud. Next slide, please. So for May, the key buzzword that we saw was AI. A lot of companies have been leveraging on AI, they've been mentioning AI in their earnings calls and stuff like that. So we just wanted to throw up a chart here to show how that has actually affected share price performance for the month. You can see that big tech was actually the laggard. They were only up about 4 to 20%. So they're kind of at the bottom of this chart. While you have your large cap semicons faring slightly better, about 30+%. So when you talk about large cap semicons, you're talking about Nvidia, AMD, maybe Broadcom. Well, what was most surprising is that your small and mid cap AI-related software companies really outperforms. Most of these companies, almost close to doubled their market cap and their share price in 1 month alone, which is quite crazy. So when we talk about small and mid cap, we're talking about C3 AI, Supermicro, or even like companies like Palantir. Next slide, please. So you can kind of see, how the impact of AI has had on a lot of these tech companies. Just the hype of it. Right? And so when you have these two charts here, we basically are two scenarios that we're actually looking at. We're trying to compare it to what happened during the dot-com bubble when Cisco back then was really the most hyped stock. So the first scenario that we're looking at is that we assume that euphoria has kind of peaked. In which case, Nvidia's current valuations the company is trading about 184 times PE, which is quite elevated. But when you look at it at the peak of the dot-com bubble, when Cisco was trading at 382 times, it's roughly only about 50% of what was happening back in 2000. And so our second scenario is that if you're assuming right now that the AI hype is still in its infancy, and there's still plenty of room to run for Nvidia's price, which is the chart on the right. You can see that from the 2 years prior to the peak during 2000, Cisco's share price actually went 7x, so it grew quite significantly. And if you assume that right now we still got another year to run out of this AI hype, Nvidia's share price is kind of trending. It's almost doubled, or slightly more than doubled its share price in the last 1 year. And in the next year, it could, if it's following the similar trend, it could reach about 7x, which is similar to the dot-com bubble. So we just wanted to throw up two scenarios out here just to kind of compare, what's happening right now and what's happening back then. Just for some comparison, because AI is generating quite a significant hype right now. So with that, we'll move on to individual counter updates. Next slide, please. So we start with Meta. They got fined again for some data privacy violations in the EU, where they were mainly fined for transferring some of the users' personal data from the from Europe to the US without proper safety guarantees. So this $1.3 billion fine was their third and largest fine for the year and represents about 5% of their 2022 net income. So it is, a fairly significant amount from their bottom line. Secondly, they were forced to sell Jiffy, and they actually sold it to Shutterstock for $260 million loss. They were ordered to sell. So a little bit of backstory is that they actually acquired Jiffy in 2021. And the UK Competition and Markets Authority actually ordered them to sell it. They actually filed an antitrust lawsuit in 2021 against Meta to sell this company, because they said that this was monopolistic and so on. And so they won the court case, and Meta actually had to sell it for quite a big loss. Finally, for Meta, they're actually wrapping up their final round of layoffs, and this will be their third and final round, impacting teams from marketing to engineering, and it's quite significant because their previous layoffs actually didn't really touch a lot of the technical professionals. But what we're seeing in this final one is that they actually did. The company actually did mention that they would be removing some of their engineering teams and downsizing a lot of other teams as well. So far, more than 25,000 employees have been affected by layoffs in Meta over the last 9 months. We actually maintain a neutral rating on Meta with a target price of $235. So moving on to Netflix, they had a very positive update on their ad-supported service, which is a new service that they launched over the last 6 months. So right now, they mentioned that they're currently seeing about 5 million monthly active users on using the ad-supported service, which is quite impressive given such a short time frame. At the same time, more than 25%, so about 1 in 4 new signups are actually opting into this ad-supported service, which is great for the company because this service is actually margin accretive. Compared to their basic standard plan. So just, I guess, good news for them, and that actually kind of sent their share price moving upwards for the month of May. Secondly, they actually saw a strike by some of their Hollywood writers, and this is the first time the writers were on strike since 2007. The main reasons for the strike is that they're looking for more inclusions in residuals and payments, so they're looking for more money. Because they know that a lot of these streaming companies, especially, are making quite a lot of money off their content, and they're also concerned at protecting some of their jobs against AI. Lastly, streaming remained relatively flat month on month, so not much news there. They're just kind of seasonally, it's a little bit of a down month, maybe because the weather is actually heating up in the US. And so a lot of people are actually spending more time outdoors compared to just sitting at home watching shows. We actually downgrade our rating from accumulate to neutral, but we maintain our target price for Netflix at $388. And we downgraded mainly because of recent share price performance. So moving on to my last counter, which is Alphabet. Alphabet, we think is going to be one of the largest players in AI along with Microsoft. And the only real news they have is that they're actually launching new AI tools again for some of these marketers, which is I guess aligned with what they've always been saying. It's quite interesting to note that about 80% of advertisers that use Alphabet actually use at least one AI-powered search advertising product to help improve efficiency and returns on their advertising campaigns. So for Alphabet, we still maintain a buy rating with a target price of $131. That's it for me. I'll hand it over to Max to continue with Apple and Amazon. Thank you.
Thanks, Jonathan. I'll start off with Apple. So the first major news for Apple is that they restricted some of the employers in terms of the usage of external AI tools, and this includes things like ChatGPT as well as Microsoft GitHub Copilot. Just for your information, GitHub Copilot is an AI software. It's an AI software that helps users to write codes where the users just simply put in the request in natural language format. So, and then the GitHub Copilot will generate the codes automatically for you. Yeah, so and the reason behind this restriction is because Apple wants to safeguard against the potential leak on confidential data, and this is be it with regards to their future products, which Apple is very known for being very secretive about, as well as any other data related to their consumers. Yeah, and then the second news is that Apple signed a multi-year, multi-billion-dollar deal with Broadcom, and this is to develop 5G radio frequency components. This news is quite interesting because at the start of the year, you may remember that Apple was reported to have plans to replace components made by Broadcom as well as Qualcomm with those designed fully in-house. So yeah, we're not really sure how this deal will be related to those plans mentioned before, and this is because the components involved in this deal will also be different from the 5G modems developed by Qualcomm. So yeah, those are the two major news for Apple. So in terms of our comments, Apple definitely has a cautious but sure stance with regards to generative AI, as can be seen from their comments given during the second quarter earnings call. Where Apple said that they are currently very actively taking steps to ensure that the generative AI is safe for general use. So they are not pushing the technology as much as other tech companies, as John mentioned before. And they say that although they're excited about it, they want to make sure that they can mitigate any potential harm caused by the usage of generative AI. So yeah, although Apple is not the front runner in the space, they are actively developing their own large language models. And also they are also set to have acquired several AI startups. So we think that this means it will be only a matter of time until Apple incorporates more of the technology into their own products. Yeah, for our valuation, we maintain our accumulated rating on Apple with a target price of $183. Then moving on to Amazon. So the first news for Amazon is that it settled two different surveillance complaints. Firstly is that it has agreed to pay $5.8 million to settle allegations that its Ring doorbell employees has gained improper access to the videos belonging to their customers. And then separately, they are also agreed to pay a $25 million fine for improperly retaining children's Alexa voice recordings, as well as collecting their geolocation data, which apparently violates one of the FTC regulation. So yeah, in total, Amazon needs to pay about $30 million in fine. But I mean, this is quite insignificant if you talk about their financials in a given quarter, whereby they generate about $100 billion in revenue for each quarter and about a couple of $1 billion in the bottom line. And then for the second news is that Amazon is overhauling their delivery network, and the company has created 8 self-sufficient regions across the US. And this is quite a dramatic change from their previous practice of transporting desired products across the country, no matter where the buyers and the sellers are, which could potentially result in higher delivery costs. So because of this, Amazon aims to minimize the minimize the need to move items outside of each region, and therefore it will also affect the search results the customers will see, because products that are already in the region where the customers are will appear higher in their search results. And overall, Amazon hopes that this new initiative is able to reduce the overall delivery time. So yeah, the delivery network overhaul shows that Amazon is still committed to expanding its margins further, because firstly, Amazon believes that shorter delivery time will encourage customers to shop more, and secondly, short distance delivery also costs less, which means that Amazon can increase their revenue while at the same time also decrease their cost. Yeah, and then so putting that aside, we would like to also note that the recent AI boom is also a potential tailwind for Amazon, particularly for their AWS, because as we may all know, generative AI and large language models require a significantly higher amount of computing power, which means that the customers will likely need to upgrade their subscription tiers for their cloud computing needs. However, we downgrade our rating for Amazon from accumulated to neutral, but we maintain the target price of $120. And the rating downgrade is mainly due to the recent share price performance. So yeah, that's all for me. I'll hand over my time to Ambrish to talk about Microsoft. Thank you.
Thank you, Max. So moving on to Microsoft. In May, the European Union, it approved Microsoft's proposed $69 billion acquisition deal for Acquisition Blizzard. So Acquisition Blizzard, it's basically a video game publisher for popular blockbuster titles like Call of Duty. So the European Union, the European Commission, it basically it approved the merger deal mainly after Microsoft. It agreed to allow its rivals like Nintendo to offer Call of Duty on its own cloud computing platform for a period of 10 years. So, and this decision, it comes after in April when the UK antitrust regulators, they had rejected the deal mainly on the concerns that it would lessen the competition, as Microsoft, it holds a leading position in multiple market areas like its Azure cloud platform, as well as Office 365, and also its Windows operating software. So even in the US, the Federal Trade Commission, it has filed an antitrust case against the merger deal to block the deal. And the trial, it's expected to begin in August. So, however, we believe that the deal should go through by the end of this year, mainly because Microsoft, it's not looking forward to make the content exclusive for its own customers. However, it's looking forward to offer concessions to its rivals for a period of like 10 years. Meanwhile, for the AI, Microsoft, it has already integrated its AI capabilities into its core products like the Bing search engine, as well as Office 365 and Azure. And management, it had mentioned over the call in the third quarter of earnings call that it is witnessing early traction in its AI related services. And it's particularly its Azure OpenAI service customers, they grew by 10 times on a quarter-to-quarter basis to 2,500 customers. However, we believe that it should enhance Microsoft's competitive position, but it should not significantly contribute to its top-line growth in the near term. So overall, for Microsoft, we have an accumulated recommendation mainly because the two growth drivers in the long term for Microsoft would be its cloud computing platform, which is Azure, as the companies, they digitize their operations. And second one would be its Office 365 productivity software, which should benefit from rising need to manage tasks. Next slide, please. To conclude, for FAANGM, we remain neutral mainly because its price to sales multiple, it has reached more than one standard deviation of from its long-term average. And secondly, we witness the companies, they are expected to witness short-term weakness in demand for tech consumer goods, digital advertising, as well as cloud. So that's all for FAANGM monthly. I would now like to pass on to Glenn for Singapore Banking Monthly.
Thanks, Ambrish. So for the banking monthly, we will start off with the interest rates, both Singapore and Hong Kong. For the Singapore interest rates, it has started to flatten in May, and the 3-month SORA was only up 1 basis point to 3.61%. And this month-on-month increase was the lowest recorded since November 2021's month-on-month increase of the similar 1 basis point. However, it has improved, the 3-month SORA has improved by 317 basis points year on year, and it's still high, 41 basis points higher than the first quarter average. However, this sort of flattening of the interest rates is good news for consumers, as they would start to see their loans interest flatten. For the Hong Kong interest rates, it has surged and it has reversed the decline from the previous few months. So the 3-month HIBOR was up 82 basis points month-on-month to 4.41%. And this month-on-month increase was a reversal of the previous month's decline of 21 basis points. The 3-month HIBOR has also improved by 357 basis points year on year. Now moving on to the loans growth. The loans growth, just to highlight, Zane is not here today as he's on reservice, so there'll be no TA for this week's webinar. If you like to, you can always put your questions up on TA questions up on Poems, the app, and he'll try his best to reply when he's back. Thanks for that. Okay, so for loans growth, for Singapore loans growth, the overall loans growth to Singapore residents fell, and it fell by 5.86% year-on-year in April. And this is actually the last time we saw this magnitude of decline was in 2016. For the segments, the business loans fell the largest, and it fell by 8.44%. And the largest segment, single largest segment to fall would be the manufacturing segment, which fell 13.56% year-on-year. However, the building and construction segment, which is the largest business segment, it only fell by 2.77%. So the manufacturing segment was actually the drag for the overall loans. For consumer loans, it was down only slightly by 1.53%, as the dips in other segments were offset by strong loan demand in the housing segment, which grew 1.78%. For the total deposits and balances, it continued to grow, and it grew by 3.62% year-on-year. However, the current account and savings accounts, or CASA proportion, it continued to dip. It dipped by 0.1%. So this is a very small dip compared to the previous few months, to 18.8%, as there was a continued move towards the fixed deposits due to the high interest rate environment. For Hong Kong loans growth, their loans growth declined 3.28% year-on-year and 0.69% month-on-month in April. Now moving on to the SGX statistics. The SDAV, or Securities Daily Average Volume for May, fell by 31% year-on-year to 1,032 million, as the market sentiments continued to remain subdued due to macroeconomic factors. The VIX, which measures volatility, averaged 17.6, and this is down slightly from 17.8 in the previous month, as the market recovered from the turmoil in April. And the DDAV, or Derivatives Daily Average Volume, fell 12% year-on-year to 0.96 million in April. For the top 5 equity index futures turnover, it saw a dip of 16% year-on-year, and this was mainly due to lower trading volumes of its Nifty 50 index futures and the MSCI index futures. However, notably, all 5 index futures increased month-on-month, with the Nikkei 225 index futures showing the biggest growth of 39.1% month-on-month, followed closely by the FTSE Taiwan index futures, which rose 36.1% month-on-month. So as such, we maintain overweight and we remain positive on the banks. The bank dividend yields are attractive, with upside surprises due to excess capital ratios, as well as a push towards higher ROEs. SGX is also another beneficiary of the higher interest rates, and we expect that their treasury income will continue to increase in the high interest rate environment. So that's all I have for the banking. Manli, I'll now hand it over to Peggy.
Thank you, Glenn. Morning. I talked about Pasture Holdings this morning. This is a Phillip on the ground. This is the 3rd IPO this year we have in Singapore. Something to cheer about, to have an IPO in Singapore, actually. The market cap is very small, 32 million market cap based on last Friday's closing of 0.245. The IPO was offered 20 million new shares at 25 cents. Okay. The company sells masks. Yeah, masks. You heard it correctly. Masks, medical supplies, pharmaceutical wholesale and drop shipment. They also have 2 potential new businesses. One is the sale of the oral disintegrating strips. It's something similar to putting a strip that has a medicine in it under your tongue, so that there's a faster absorption to the body. Okay. And they have a mobile device for pet health. Yeah. And again, you probably wonder what has pet health got to do with human. Okay. Anyway, back to proper. They sell masks under their own brand, Pasture Masks. They also source medical supplies from Atkinson Medical Surgical, and then these products are also sold under their own brand name, Pasture. If I can refer you to the first donut on the right, the masks account for 38% of revenue in FY22. Their year end is in June. Okay, but masks contributed about 68% of gross profit. And you can tell by FY23, this mask, the numbers for mask is almost minimal because of the COVID reopening. Farmer wholesale to other distributors and suppliers, this differs from hyphens, although they both deal in pharmaceutical drugs, because they do cold chain manufacturing and drop shipment. They don't have direct contacts with the doctors, unlike hyphens sells to the doctors, so they have a valuable doctor database. The ODS is marketed under a Hub S ODS brand. This is very similar to IX Biopharmas, wafer IX technology. IX so is selling the products in Australia, but Pasture is looking to launch the product if they get the product approval in Thailand and Malaysia. The FurLife is an app for pet health. It's been officially launched in January 2023. It's like an online marketplace for pet products, pet pharmaceutical health, digital health trackers. So the outlook is fairly obvious. Mass products is facing declining demand. We still have a lot of channel inventory to be clear. Then there's also gestation costs that might be incurred for their new businesses. This the multicolored donut on the right. You can see that the major market is Japan, which already now for first quarter 23, which is the outer ring, is account for 76%. Last year, Malaysia was still in the picture. They sell about 20% of their products in Malaysia, which this year by first quarter, Malaysia is no longer there. There's no more sales to Malaysia. So it's just giving you this chart to highlight the how product specific they are in terms of their range. And in case you ask about comparables, the next chart will show you. Glenn, could you help to turn the page? Yeah, thanks. So the left table is Pasture's numbers. First quarter 23, they were already in the they make losses of $0.3 million US, $8.4 million US. And across the Singapore listed companies, could find probably the nearest comparable is hyphens. But again, hyphens sells directly to doctors, so has a more valuable business model. And MedTech is a producers of PPA and all the other medical supplies. Made losses last year. Big Plus produces medical devices, so their cost structure and balance sheet differs from Pasture. So there's really not one that's close in comparison to Pasture. Thanks. I'll pass it on to Paul for his part. Over to you, Paul. Thanks.
Yeah, thanks. Thanks, Peggy. Next slide. We'll move on to the usual macro news. For Singapore, we had some good numbers coming up again from the tourism sector. So for the tourist arrivals into Singapore, it was 1.1 million. This is like 100+% year on year. And I think the third or fourth month is above 1 million. We are still 25% below pre-pandemic levels. And the Chinese arrivals, although they are up like 12 times higher than last year, they are still only like 1/3 of pre-pandemic. China arrivals tend to be around 20% of total arrivals. It's only half right now. So there's still room to grow, at least for tourist arrivals into Singapore. Considering we haven't got the full-blown impact from China yet. Retail sales has come normalized back to 4%. Pre-pandemic, retail sales was about 1% only for Singapore. So this is still a strong number compared to pre-pandemic. We at least see some improving numbers out of the supermarket. Because prior to that, it was deteriorating. Like in March, it was down almost 4%. And that's because with the reopening, there was more households are consuming more outside and dining less at home. But this is starting to normalize. So at least there's still some growth. So this is at least a positive for Sheng Siong. Then in terms of if you want to know what at least Singapore consumers are spending, is a lot more still on dining out, apparel, and so forth. We also had some numbers on SBS real ridership. So it still continues to grow. I think even though the reopening impact is there, but I think it still continues to grow by almost 30%. So we still see strong growth in ridership. In terms of the external environment, for what we do is when we monitor global exports, we like to use Korea and Taiwan as a proxy to electronics. So you can see that Taiwan continues to weaken. You're referring to almost a 9-month of decline, minus 14%. I think we see similar numbers in Korea. In the US, things are also slowing down. So this thing called durable goods means goods that can last long, but it's basically a proxy to corporate spending. So it's normally machinery and so forth, excluding defense equipment. So that is also slowing down. We have a chart later, but that's also declining. So not only are the consumers slowing down, we also see corporate spending also slowing. Sorry, not slowing, the typo. Bank loans was incredibly weak in the US, it's only up 2%. So this is the slowest rate in growth for more than 11 years. I think only credit cards loans are robust. I guess this is in part what happened in the US with bank failures and bank runs. I think like was shown in the senior loans officer survey, the banks are tightening credit, and we see this in the loans data, which is exceptionally weak. Next slide. So in terms of our tactical view, for this week, it's all going to be about macro numbers. I think you can see at the bottom, under events, we're going to have a lot of macro news. The big one is, of course, on the 14th of June, the FOMC meet and they will make a decision on interest rates. So for us, we expect the Fed to pause. What they've tagged it now as a hawkish pause or a skip. I think this was mentioned by the upcoming Fed Vice Chairman. But basically what they're going to say is they're going to pause in the June meeting. But the narrative is that they might be ready to hike. That means they might hike interest rates again in July, depending on where inflation is. One way to at least transmit this narrative or their intentions is, this is a bit more technical, but every 6 months, the Fed will have this summary of economic projections or SCP. Basically, they will give their own forecast of all the Fed members. So right now it's about 5.1. So we expect them to at least elevate it, just to give the signal to the market that no, we have paused, but it doesn't mean we won't hike again. So I'm not sure how the market is going to take it. I mean, it might. I doubt it will rally, because this is kind of already well telegraphed and going to be within expectations. The CPI number probably coming out tomorrow, probably a bigger indicator. So in terms of our strategy, I think near term we have a defensive posture, because all indicators still point weakening in growth in US and globally. But for us, what we understand. For us, the question for us was like, why has been the US so resilient, the market, even though economic data is all sliding down and rates and Fed continues to raise rates. So these are some of the reasons we think. I mean, it may not be totally all correct, but at least this is why we think why the US has been more resilient. Firstly, there is the AI hype, artificial intelligence hype. I think we saw that what Jonathan mentioned. Nvidia is 184 times PE, but if you compare to the somewhat similar stock, the Cisco, which peaked at 382 times. Whether or not this mania can run, for us, I mean, this is like 110% guess, but we think it can run, because especially right now where most of the flows goes into ETFs, and with ETFs, the flows move largely to the large caps. And ETF flows are agnostic to valuations. I know they're just riding on momentum. So this could push this the hype of valuations for all the AI stocks even further. Typically, you might see the peak is when you start to see IPOs of AI stocks that start to trade at ridiculous valuations. So that may be the indicator where the mania might kind of end. Again, this is all guesswork. The second reason why we think the US market has been exceptionally resilient is also that the Fed, I guess not so well known, but because of all the bank failures in March and the bank runs, I think the Fed has given out a lot of loans to the banking system, almost comparable or at least half the level of the global financial crisis. So at the peak, the Federal Reserve was lending the US banks or depository institutions as much as 560 billion. usually most of it was through the term auction facility, but a discount window. But essentially, this is what the Fed has been lending the banks to support them. Right now, you're running about almost 300 billion. So all this has, of course, not only helped the banks, but also kind of give confidence to the market that that any tail risk or any weakness in the market, there's still that Fed put. And the other thing is also, although the new noise of recession has been around for almost 4 months, but we think it will still be either a soft landing because the jobs data has been strong, and because of inflation, the economic growth is actually still higher than expected. Now, this is a bit harder to explain, but what we're trying to say is that the nominal GDP will still be 4% or similar to what happened in 2015 and 2019. So actually GDP growth will still be healthy, although we might term it as a recession. So these recessions are not like in 2020, 2020 or global financial crisis where it was actually down 2%. We'll show you a chart to explain it because it's a bit hard to explain. But in terms of the events, this week is all going to be dominated by macro news. We have US CPI, then you have FOMC meeting, then not only that, you have the ECB also deciding on interest rates. Some of the events we have a US company coming out for webinar called Power Integrations, and the rest, Uni Asia, over all upcoming next week for Singapore companies. Then we have our usual strategy in July, US and Singapore. Next slide. So just to give an illustration of the support. So the chart on the left is Federal Reserve loans. So you take the Federal Reserve balance sheet. There's one category or assets means the amount of money they lend to the banks. So usually banks don't borrow from the Fed because it's more expensive. But during crisis time, you can see this thing really spikes up. So usually through the so-called discount window. But basically, this is the Fed lending money to depository institutions or banks. So you can see the spike in the global financial crisis, then it kind of tapered down. Then because but recently, because of the bank runs, it has surged up. And there's already, so that's why the US market has been resilient, because the banks, the Federal Reserve have really been pumping a lot of money, liquidity into the banks. If you want to go into more details, the peak of the amount of loans they gave was on the week of 4th March, sorry. And right now we've actually, the Federal Reserve have been supporting the banks a lot. Most of it is through the FDIC breach. But anyway, you can see it's almost 300 billion and it's kind of helped support the banks. So there's a hidden kind of global financial crisis kind of Fed support. Next slide. Okay, this is just more indicators that the things are still heading south. So on the left is the bank loans, commercial loans by banks. So that is still weakening. You can see it's one of the worst in more than 11 years. And also corporates also not spending. So these are corporate new orders for corporates in machines and so on. So that's also sliding. So these are some of the reasons why we think the economic growth continues to kind of soften, and that makes us a bit more defensive in our strategy. Next slide. So okay, this one is a bit more complex, but what we're just trying to say here is that any recession that you hear, it won't be similar to what you see in the global financial crisis, where if you focus on the orange line, during the global financial crisis, the nominal GDP, that means this is the GDP, you don't go and adjust it out for inflation and so forth. That actually slided almost 2%. And of course, the COVID recession. So between that, the pre-pandemic, we were averaging 4%. So even though we might go into a recession, we are still hitting the 2015, 2019 kind of GDP kind of growth. So this means that any weakness in corporate earnings won't be so severe. What we think is that the drop may not be high, but we're going to have at least a few years of sluggish growth. This is what we think. Although you may not collapse, but you will be just very sluggish because rates are high and there is no strong global stimulus for demand. I mean, China is not there. There's no fiscal spending by the US. So we think you won't collapse that much, but growth for the next few years will just be very slow, back to the pre-pandemic norms. Okay, with that, I think we ended. I think we can move on. Yeah, sorry, this week there's also no TA because Zain is on reservist, but he'll be back next week. So apologize for that.
Yeah, I can take a couple of questions. There's one here. What is your view for Google and Amazon? Both stocks still not moving up like the rest. So I'll take the Google one first, and then Amazon I'll leave it for next. So when you look at Google, I guess one of the main, right now they're about 15 to 20% of their peaks. But I think one of the reasons why they haven't really been moving up like the rest is because they're still kind of dominated by digital advertising, and the digital advertising industry isn't showing any signs of imminent recovery. It's a little bit different from Meta. Meta, even though they are in the digital advertising industry, why they're doing so well is because we think it's because they sold off quite significantly. I think they sold off about 75-80% last year. Whereas if you compare that to Google, Google was down only, I believe, 30-ish%. So it didn't drop as fast, so therefore it's not really going to go up relative to other digital advertising companies like Meta. Yeah, so we do think that I guess for Google they almost hit our target price for the year. But we do think that with AI, they've always been investing in AI, and we do think that once the digital advertising industry kind of starts to pick up a bit, then that's potentially where we could see Google start to run a little bit more because they are the leading player in that space. Hope that kind of helps. I'll take another question here before I hand it over to Max. There's a question here on TDCX. What is their business standing outside of SG, Malaysia, Thailand, and Philippines, and who are their main competitors? Okay, so for TDCX, about 40%, close to 40% of their total revenue actually comes from outside of Southeast Asia. Philippines is interesting because the way they categorize their revenue mix is based off languages. So for Philippines, because it's predominantly English, so it's not really classified under a Southeast Asian language, and therefore it is part of the 40% revenue mix from outside of Southeast Asia. But they recently expanded into Indonesia. So you're not really going to get much revenue from there, at least for the first couple of years, but that should be good moving forward. They also are expanding quite a bit in Europe and in Latin America. So I guess for TDCX, their main goal of expansion right now is twofold. One would be to incorporate new languages, because once you have new languages, you can cover more geographies. And two would be when you're physically in a location, when you physically set up offices, it's easier to cross-sell existing clients who want to expand into these regions. In terms of who are their main competitors are like TaskUs, Concentrix, Tellus, so other CX players. But I guess the one up and the niche way that TDCX targets their customers is that they mainly target your tech companies, these super high growth new economy clients. So they really rarely deal with a lot of your older, more mature industries, and that is a lot of their competitors mainly focus on these kind of companies instead of your fast growing new economies. So that help. I hope that helps with TDCX. I think I saw another one for Grab. Let me see. Sorry, I think it's in the chat. So lately, Grab has gone up quite a bit. Is it time to sell? Unfortunately, we don't really cover Grab. When you look at it, since their IPO, they've been down quite significantly. Let me pull up the chart. Unfortunately, we don't have an answer from a TA perspective because Zane is not here. But when you look at it from a business fundamental perspective, they are still not yet profitable. So I think until there are clearer signs of the company being profitable, at least in certain segments, then we should start to see Grab's share price run a little bit more. Unfortunately, the areas that they're in, it's very difficult to get any operating leverage because there's only so much take rate they can really impose on a lot of their industries, and so it'll be interesting to see how Grab maneuvers this as they continue to spend a lot of money on incentives and so on. Yeah. So I think that's all for me. I'll hand it over to Max to complete to answer the Amazon question. Thank you.
Thanks, John. Hey, can you hear me?
Yeah, we can hear you.
Okay. Yeah, I think my camera is there's a technical hiccup on my camera, but anyway. Yeah, for Amazon, yeah, the share price is still about 30% below its peak. And yeah, I think the movement is not as much as other stocks, and this is mainly because management themselves has already issued a cautious guidance for their AWS segment, and AWS is the only segment that investors and other analysts are very excited about because it's much more profitable. But the fact that management themselves already issued a subdued guidance for the segment, and then despite the recent AI boom, it as I mentioned just now, there is a potential that there is going to be a tailwind for AWS, no doubt about that. But to what extent is yet to be seen. So which is why I think like investors are still very cautious about any potential upside for the share price. And I think this is going to stay on that way until the company issues a more upbeat guidance for the subsequent few quarters. Yeah, I hope that answers your question.
Yeah, thanks, Max. Okay, let me try to take a few of the questions. Okay, I'll do the Singapore one first. It's asking, what is your prediction for Singapore housing loan rates? And you did mention SORA had the lowest increase. Do you think it will rise or fall in the next few months? And how long does this SORA take to filter into mortgage repayments? He thinks it's 3 months. Okay, so for housing loan rates, it will be, I mean, the good thing about Singapore banks, I mean, coming from an analyst view on the Singapore bank stock, so not really from a consumer view. So from looking at how the banks sort of price their rates, is mostly, for Singapore banks at least, it's mostly floating. So floating means that they'll just take the SORA and then they'll put in their spread, that's how much they earn. So it's really dependent on the interest rates. And that goes into the second question, which is asking, you did mention that SORA had the lowest increase. Do you think it will rise or fall in the next few months? So yes, I think the interest rates are starting to plateau, and we could see maybe more stagnant growth for the SORA at least. However, I mean, it was shown, in the last a couple of months ago where the SORA dipped slightly, but then it rebounded and then it went really high. So I think it's also quite dependent on what the Feds want to do, and if they hike further, then the interest rates could go up, and the Singapore interest rate would follow. And okay, the last question being, how long does this SORA take to filter into mortgage repayments? I think it'll be very hard for me to answer this question, as it's very dependent on the kind of sort of mortgage you have taken with the bank. So I think it'll be best if you ask your own bank, and I think they will let you know how long does it take to take into effect. Yeah, sorry, I can't answer the last one. It's not out of my purview. Okay, I think there's one more question on US banks. The question is this now a good time to look at US banks, and which are the two that would be on your radar? Sorry, we don't really cover US banks, so I don't specifically say whether it's now a good time to look into the US banks. And I think for the two, I mean, just on very broad base kind of looking at, I would say maybe the two largest US banks in the US. So that would be namely JP Morgan and Bank of America. So I guess if you do want to invest in the US bank, you would have to go into the safest options, right? With what's happened in the last few months. And that would be the two largest ones. And there's JP Morgan and BOA, Bank of America. Let me just scroll through and see whether there's any other questions for me. Okay, I think that's all for me. I'll hand it over to the rest of my colleagues. Thanks.
Peggy, you want to go first?
Yes, sure, Paul. Okay, there's a question on Singapore Airlines. The question is, there is an ongoing rally for SIA stocks, somewhat similar to AI stock hype. Can you help provide analysis to this hype and if it will last for a while? I don't believe it should be at this price. Why so? You will look at just look at Cathay Pacific's numbers. They are bringing back the capacity very quickly. Year to April, their total capacity is already more than the whole of last year. So they can see how fast they can ramp up the capacity. And of course, a lot of that capacity is put into North America and Europe, which are also the two areas that have been driving SIA's yield as well as load factors. And if you comparatively, maybe in future meetings, I will also share SIA's operating stats. The numbers for April, and in fact, we have the number for April. Yeah, the numbers for April has already starting to come off. For capacity, the increase is lower year on year, and also month on month. For in fact, across the board for passengers, everything else has been starting to ease. Also reflecting the pressure that as these regional carriers start to put in their capacities, the airfares should be looking to come down, especially if after this summer holidays by the end of June. So our view is the valuation, which is currently pricing at like let me see, at a market cap of 21 billion, right? In the good old days when even pre-pandemic, they only trade at about 10 billion the max. So you are actually doubling the pre-pandemic kind of valuation, and not forgetting that they have a debt to be repaid. The MCB is a debt, right? No matter how we look at it, that has to be paid back very quickly. And because of that payment, the cash flow next year for FY23 ending March will turn the balance sheet into a negative net cash. Net debt, our projection is about 7 billion net debt. So all in, it's very difficult to be bullish on SIA unless there is some corporate exercise that's going to happen, which there's a few rumors flying around that might help to improve their balance sheet a little, but it doesn't change the picture that the airlines operating environment is going to be getting more competitive, especially if not just Cathay Pacific, if you have the China Airlines also putting in the capacity, and that will really drive up the industry capacity to a normal level, then SIA's ticket prices have to come down. And of course, the cargo side is weakness for the last 4 months, for the first 4 months of this year. I hope I answer your question, but if it's not clear, please post again. I'll try. If you have any specific areas you want me to address. Thank you. I think that's, can't see any more questions from me. Or we want to take over from here.
There's some sets
Yes.
question if you want to take
Uh,
under the chat. Yeah.
oh, what is target for sets for 23 to 24 and reasons for growth? Thanks. Target, I think you are talking about profit, I think, probably. Yeah. We have
Target price, I think. Yeah.
Oh, target price. We're still keeping our target price to $2.51. Mainly based on the discounted cash flow discounted cash flow method for the cash flow that they will generate from the business. We change it from a PE method because it's earnings probably going to look quite challenging with the consolidation of WFS from April 2023, because WFS is mainly a cargo player with some ground handling business. Overall, the cost of debt in the WFS is very high, and SETS is trying to solve that right now. Even if they are able to lower the cost of debt, the cost will stay high this year because they had to redeem the bonds at WFS that will keep their cost high at about the cost of debt at about 6% this year for 2023. So the growth, if it happens, will be 2024 when you see probably a rebound in cargo industries. But overall, we are not optimistic for SETS in the near term. Thank you.
Okay. Yeah. Thanks, Pat. Okay, I'll just take on some as you all identify. Any AI local stocks to recommend, or in Hong Kong? Okay, Hong Kong we don't cover. There's really no pure AI stock. Maybe that's why we don't get the euphoria. As a segue, I guess for us, apart from those who offer AI or sell the chips, data center AIs, we also think cybersecurity companies might be another area that might benefit from AI, because like what was mentioned by our US team, not many corporates can actually use the so-called JetGPT because of security reasons. So there might be some avenue for growth for cybersecurity companies, and cybersecurity companies will include companies like someone like StarHub that has a cybersecurity company inside, where most analysts only value that cybersecurity business at telco valuations, 6 times EV EBITDA or 7 times. So I think for me, like StarHub will probably be a 2024 story as the whole restructuring gets out of the way. So there isn't any that I can think of. The data centers we did ask about, I think any impact from greater use of AI means you need more power. Most of the data centers are triple net, so most of them not responsible for managing it. So that also is could be quite insignificant. So we don't have a real pure play for AI in terms of from the Singapore context. Hi Paul, in your Singapore Weekly, can you include the fund movement in and out of local stocks, like institutional buying, selling, and retail buying? Sometimes there are good opposing ways and a few stocks that were impacted. Yeah, we will try, because apart from doing it manually, we always try to get this data from Bloomberg, but Bloomberg always very challenging they couldn't really give us this data. For us, of course, like you mentioned, I think it's a good contrarian indicator. I mean, if everyone's selling, that's the best time to buy. We were actually trying to get the data for copper buybacks, but Bloomberg just couldn't get. So I'm not sure how we're going to capture this, apart from doing it manually, which is a bit more expensive. And like SGX doesn't give any APIs, so we will try our best to compile it. We'll take a note of this and find a way to get the fund flows. We always looked at it, especially share buyback. I thought that was a very valuable thing, but very challenging to get it. And SGX doesn't give any proper Excel download. No, I guess they're not even bothered, I guess. Let me move on to the next one. Hi Paul, what do you think of Thai Bev? So Thai Bev, sell down has been mainly because of this anti-monopoly law. But so far, the anti-monopoly law means to introduce smaller players. It doesn't mean to break up. I mean, from what we understand from their 100-day, I don't know, manifesto or roadmap. So it's not to break up. So just to backtrack a bit, Thai Bev has a monopoly, 90% market share or more in the spirits business, which is like a sugar-based rum. So white and brown spirits. So we think they will introduce, maybe you can set up your own, I don't know, distillation, home brewing. Obviously, it's not going to impact the company much. I mean, it's like Singapore starting all these small beer breweries. It's not going to, especially you don't have the distribution, you don't have the scale. It might be a very niche thing. And we think any impact from this anti-monopoly law from introducing smaller players, it's not going to cut it. I mean, you're talking about thousands of touch points by Thai Beverage, and even if you do get bigger, Thai Bev will just buy you out. So if the sell down is because of that, I think it's a bit unwarranted. Especially this stock is now trading at, I think, 10 times PE based on our forecast, and this is still a monopoly stock. Now, I'm sorry, this stock still has a monopoly, not monopoly stock. Thanks. The next one on, I'll hand it to Darren for Silterra. Let me answer this first. Now, Paul, any latest update on ComfortDelGro given its price action downtrend? Yeah. Okay, so for okay, so ComfortDelGro has not been a good call. I mean, the stock has been down. We've been promoting it a lot, and the reason is because we still like it because the fundamentals is still improving. It's just that the numbers has not changed. So the fundamentals has been improving because it is not only a P&L story because the earnings are rebounding. It's also a balance sheet story. Pre-pandemic, they had, I think, probably less than 100 million net cash. I think now they have like 700 million net cash. So and they're starting to use the funds now. The book value is about 120. Management has, since the renewal of the mandate in 28, I think end April, you can see the announcements. They're almost buying back shares every day. So at least now they're starting to use the balance sheet. During the pandemic, they couldn't because it's pandemic. No one knew when. So that's number one, the balance sheet strength. Number two, we still see the fundamentals improving. The bus contract margins are, I don't know, 1 to 2% compared to maybe 6 to 7 pre-pandemic. But that's because they haven't got the repricing yet, which most of it should be done by end of this year for the UK bus. Because all these contracts will be, every year they will reprice it. So, but last year they got hit because of they had to raise the bus driver fees. And the third thing is that the taxi fleet, I mean, we didn't show you the data because it's only 1-2 months, has started to stabilize. And number two, they've also started to raise the rebates. They used to give 15% discount, so now they're giving 10%. So that's why it's hard for us to kind of say or give up on this stock, although we should also don't get so many inquiries. But it's mainly because the fundamentals are still improving. The things are still improving. Like we said, the real traffic is everything is still improving. So that's why we won't downgrade to neutral we won't downgrade it. Maybe because for us the visibility that we see, the outlook is still strong, and they are also, the model for taxis has changed. They are pivoting more towards like a Grab hailing, a profitable company, of course, not a loss-making ride-hailing app. So just profitable ride-hailing. And the difference now is that there's a shortage of drivers, and that's why even like we highlighted last week, even operators like Gojek want to work with ComfortDelGro because they have the drivers. Grab does. This Gojek doesn't have the drivers for nighttime, but Comfort has the drivers for during the nighttime. So during the night shift, when some drivers do the dual night shift, they might use Gojek want to partner with them because they have the drivers. At night, nobody drives on Gojek because these are all part-time drivers, I guess. Okay, that's a very long answer, but anyway, Darren, you want to take on the next?
Yeah, hi there. A lot of questions from me. One of it is the bankruptcy of Sixtera. Do you think this is negative for CapitaLand as Center Street, Neighbourhood Industrial, and counters with BC exposure in general, and how to mitigate such risks? Yeah, so for Sixtera, is a third-party co-location player. So the biggest hit of the Cyxtera bankruptcy is of course the digital core REIT with about 22.5 or 22.4% of their rental income from Cyxtera. And then Maple Street Industrial, they came out and said about 3 point something, mid 3% rental income, and Capital DC is also affected. They're affected. Their rental income contribution from Cyxtera is about less than 2%. So they remain current on their payment for until May, but June they've yet to pay for both Maple Street Industrial and Digital Core REIT. Yeah, so right now Digital Core REIT, they came out to say that they do not really see. I mean, of course, there's a huge impact there, but they are confident that because the rents that Cyxtera are paying them, right, is actually lower than the market rents. So they expect that they are able to kind of lease their data centers directly to the end users at a higher rate. But of course, all these will have some turnaround time and some, like empty vacancy time, or they try to get their leases in place. So of course, all these is negatively affected when 22% like suddenly, just especially for Digital 22% just vanishes of their rental income. That's a worst case scenario. But right now they are undergoing the debtor in processing. They've gotten 200 million to help fund the continuing operations. So how to mitigate such risk is basically the data center REITs, you can just lease directly to the end users rather than leasing to all these third-party co-location players. Yeah, so I hope that answers the question. So yeah, but definitely in the near term is negative because there's a lot of, if they want to kind of get new tenants, there's a turnaround time. Yeah, the next question is, appreciate your advice on whether to take up the AIMS APAC REIT IPO. Preferential offering rather, not IPO, sorry. Yeah, so for the preferential offering, it's priced at 1.189, if I'm not wrong. And the last I saw, the price for AIMS APAC REIT is also around there, 1.19. So just to get the share price, doesn't really make much sense to take up the preferential offering because I mean the current price is really trading at the preferential offering pricing. There's no point in, if you want to add, you can just buy the shares of the market, and it won't dilute yourself because the preferential offering is at the same price as the current market price. There's no dilution on your part as a shareholder. But I mean the issue now for them is their ICR has dipped, their adjusted ICR has dropped below 2.5 times. So they cannot bring their gearing up to 50%. Their cap on gearing is 45%. And they also still have they have the PERP, which was one of the reasons why the ICR also dropped to under 2.5 times. Yeah, so short answer is not much difference because the share price is similar or rather trading around the preferential offering price. Yeah, I think that's all for me. Hand on to the rest of my colleagues. Thanks.
Yeah, okay, I'll try to take on some because there's one C-term one, Peggy, but I'll take on this Singapore presidential elections. What is the impact on the local market? Okay, I'm just saying this in jest. Obviously, there's no impact, but again, this is just purely as a jest. Unless we have a candidate that says that they want to set up a fund specifically to boost the local stock market, or a candidate that says, no, you want to move from T+1 to T+20 or something like that. Again, this is purely as a joke. I mean, obviously there is no impact, but unless you have this candidate that says such comments to ultra support the local market, otherwise there isn't, which is not happening. But again, this is just purely as a joke. Okay, so don't take it as not as an official kind of view. Because when it comes to politics, we're especially sensitive. Let me just take one more question. We'll pan up to the rest. The because this is regarding the AI stock is in the chat group, but for AI stocks in the local market, how about our local semiconductor stocks or stocks like UMS, which sells chip making components? Yep. Okay. Let me just explain. Firstly, that the AI impact may not be that material. And why I say that is that, okay, just to give you an understanding. So UMS produce equipment for applied materials. Then applied materials will sell the equipment to, let's say, TSMC. Then TSMC will build the chips for NVIDIA. So firstly, UMS doesn't know who is the customer, whether they're using AI chips. But the bigger problem now for UMS is that TSMC has cut their capex, which will affect applied materials, which is a UMS customer. I'm sorry, a bit confusing, but the key thing is that even though we have all this AI hype, the TSMC has cut their capex in June. This is their third cut since October. So October they cut once, January they cut once, and June they again cut. So basically UMS customer has cut their spending. So I think that's a bigger worry. So even though there's all this AI hype, it is not moving the needle for capex. That means it's not moving the needle for UMS customer, which is applied materials. Allegedly applied materials. Yeah. Okay. Can anyone take up the rest?
Okay, I'll do this. I'll do it. Okay, there are two questions. One question is, what is the target price in 6 months for Sembcorp, Keppel Corp, and Seatrium? I assume he's asking about fundamentals because Zane is not here, so the technicals will get him when he gets back from his service. Our target price for Sembcorp is $5.06. I know it's way below the current market price, but the current market is also being driven up by some news, some expectation that they will sell Samways. The price being thrown around is between 500 to 700 million Sing dollar for the 100% stake in Samways, which look highly unlikely. Like for instance, Keppel bought 800 Super last year at a total valuation of about 350 million US. That's just for reference. And also another rumor that Sembcorp might be included in the MSCI index, but I don't know. I'm not sure which MSCI index they're talking about. So these two news have been driving up the share price. So, but based on just fundamentals, we think it still should be worth about $5.06. For Keppel, our target price is $7.01. Yeah, there's no change to that as well. Keppel is based on some of the parts, based on the valuation of their stakes in the various listed REITs as well as the core business. Yeah. For Seatrium, we don't have an official report on them yet, so we don't have a target price for them. But maybe to note is that Keppel, which own 5% stake in Seatrium after they sold off their Keppel O&M to Seatrium, they have been cutting down the stake. The stake now is below 3.6%. So it's still quite a lot for them to sell for Seatrium shares. So therefore, maybe it's good to wait. Okay. The second question is also something I want to elaborate on Seatrium. The second question is the Seatrium legal case a case for concern, hence the price trending down? Yes, I feel it is because if you look at Keppel O&M, Keppel O&M also underwent the same kind of corruption investigation by the Brazil authority. It took them about 7 years to resolve. Started in 2014, 2015, only concluded in December 2022, and then they quickly sell off the entire Keppel O&M to Seatrium. And Seatrium's investigation from Brazil authority has just begun. Not sure whether it will take another 7 years, but whatever, it will be a painful process. And Seatrium's order book right now of 20 billion, 2/3 or maybe 60% of that is from Petrobras, and that's for 3 contracts. So I'm not sure if this investigation will affect these existing orders. or whether there will be affect the ability for them to secure new orders from Brazil. So these are concerns that will be that we'll be watching. So but don't think it's advisable to chase up the price based on higher oil prices. If they are going to still be in the rate in FY23, and if you are in the rate even with the oil prices at this kind of good levels, you just miss the boat on this cycle. And that's my view for C-Train. Thank you.
US team, yeah.
Yeah, I'll take a couple of questions. Then I think Ambrish has one. So there's one question here. What price NVIDIA for it to reach the peak of Cisco PE 282 times? So actually, can you go back to the Glenn? Can you help me to go back to the chart? Thanks. Essentially, it won't be just double, but I think when we look at the price action, yeah, the chart on the right, that will probably be a little bit more representative. If you do expect the AI hype to continue, just based on this chart, NVIDIA's price would be close to 1,000 if it's going to be similar to Cisco. Yeah, it's not just like on the left chart on the left sided chart where it's just ×2, because that's a price to earnings chart here. So hope that answers your question. There's another question here on EVs. Against the backdrop of keen competition from the various EV car manufacturers in China, what is your outlook on NIO, which share price has gone down quite a bit? So just a disclaimer, we don't cover any cars, we don't cover any, especially in China. But for NIO, they had a pretty bad quarter earnings. Yes, the last trading session, I believe it was Friday. So they missed on revenue, they missed on earnings. At the same time, their deliveries were down sequentially, I think 20%. But the biggest thing for them is their margin compression. So their vehicle margin was only 5%. I believe a year ago it was closer to 20%. One of the biggest reasons for this is because Tesla was cutting prices quite heavily in China so far this year, and so once Tesla, you've got this pricing war where once the EV prices start to come down, then NIO kind of has no choice but to cut prices as well. But because their margins aren't as strong as Tesla's, they can't really hold their margins as well, so they just got hit pretty badly. I think if you think about their share price, it's down like 80% plus from its highs. It's not looking too good if if results are going to remain like this, where they're still loss making, their vehicle margin is only 5%. Like almost like might as well not do it, unless they can find some other way to boost up their margins and increase their vehicle sales. Because the forecast for this coming quarter is also not great. For the second quarter, they also expect vehicle deliveries to be down another 20% quarter on quarter. So in the near term, doesn't really look that good for NIO. Coupled with the fact that competition in China is very tough. You've got other players like BYD and such that are really dominating the market. So hope that kind of helps with a bit of color on the market. I hope it answers your questions. Thanks. I'll hand it over to Ambrish for a question on Adobe. Thank you.
Thank you, John. So there was one question with respect to Adobe. Any comments on Adobe if its share price still has room to rally after the gap up last week and in view of its coming earnings report this week? So basically Adobe stock, it has rallied about 5% in previous week and almost like 30% over the last 1 month. And we believe this was mainly because of the AI hype. Because recently Adobe it had announced its own AI tool, which is named Adobe Firefly, and this particular tool, it would help enterprises basically to generate images from text-driven descriptions. So the rally was mainly because of this AI hype, and it would be difficult to predict if it would rally further. And with respect to its earnings report, the consensus estimate its calls for a revenue of about $4.4 billion and earnings per share of about $3.52. And we believe that Adobe, it should beat this estimates mainly because of continued demand for its products, as there is rising demand for digital content creation, mainly by individuals as well as companies in order to be competitive. And also because of the paperless workflows, from paper to digital workflows migration, as well as e-signatures, migration to e-signatures and cloud. So that's all for Adobe, and I would like to pass on to the rest of my colleagues. Thank you.
Oh, okay, let me just try to take on the rest. So that what's your take on all futures for the next 6 to 12 months? I think it's going to be tough for my own guess. I mean, because all is like a graveyard when you want to try to predict this. But for me, I think it will still be weak, mainly because of the weak economic conditions in the US. I think the summer driving season now coming up, that will probably normally that's where the oil prices tend to be a bit more vibrant, but doesn't seem so. So near term is weak, but longer term, of course, the bull case is still there. All demand is always hard to predict. It's like, how do you predict China's demand? Nobody knows. It's more like guesswork. But at least on the supply side, you can see that there's no banks willing to fund a lot of these oil companies' exploration. And yeah, so I think from the supply side, all is favorable from that point of view. But near term, it just goes in line with our own view of where global growth is. Things are slowing down. It'll be interesting to see the US summer season driving. Yeah. With Genting still trending down, results below, but this was 2 weeks ago. I'm a bit surprised the thing was down, but although we don't cover Genting, our thoughts was always, I mean, if you want to buy Singapore, it doesn't have to be Genting. You always buy Las Vegas Sands. At least there's even Macau there. But we're a bit surprised, and what we mentioned, the tourist arrivals are still very strong coming into Singapore, and this will invariably kind of benefit Genting. I mean, they're the biggest footprint in casinos. So we think there's still some growth. I don't think it's the end for them. You can just use tourism numbers, and there's still the China coming up. But again, casino gaming is a very mature business. So what you're getting to see is just a lot of pent-up demand, which is exactly what Las Vegas Sands said. There's a lot of pent-up demand. Just that this pent-up demand, we just think that might last until end of this year, and then that's it. Yeah. Statistics important. Yep, thanks for that. Yeah, just for the what's your take on Delphi? Okay, I'm not sure Peggy got anything to add. We don't have a TA reading on Delphi, but I think for me at least, I haven't met them for some time, but the strength of Delphi is always their market share. If you go to any, I don't know, convenience store in Indonesia or Jakarta, if you go to the shelf space, it's all Delphi. You go, so they dominate. So that's the strength of Delphi. I'm not sure about the share price volume, and with the rupiah now being resilient, I think maybe that's why brokers are promoting Delphi. But structurally, Delphi has always been the market share has always been the strongest. I mean, if you want to buy a non-Delphi chocolate, it's probably at the bottom of the shelf. So that's the level of the strength. Yeah. What catalysts, in your view, will change STI current trend? Of course, if you want to talk about STI, firstly, we must take a view on the banks. So we think the hesitancy for the banks or the dividend yields was supported, but for it to rebound, I think investors just need to know where the NIMs will settle in. I think once they get some comfort that NIMs is not going to collapse because interest rates kind of normalized, then I think maybe the banks, again, this is my own view, then the banks might kind of rally, especially if fee income start to grow. So until you see that, I don't know, maybe fourth quarter where people get a better sense of where NIMs settle. Because right now, everyone just views the NIMs to be too elevated and not clear where it will settle down. I think that's my own view. TA, yeah, sorry, we can't do any TA because Zain is on reservist. He should be back the following week. Any update on Yanlot since it cut off the dividend payment? They are hoarding cash. I wouldn't say they are hoarding. They have already 2.5 years of land banks. That's number one. And number two, there's a, in China, you cannot borrow to buy land. So most of the developers use equity to buy land, or they borrow from the offshore market, which is obviously completely shut down. So I don't blame them in a way to cut dividend, because they have to show up the balance sheet. That's why they've been buying back bonds. And their guidance for development sales cut from 60 billion from 40 billion. I think right now there's no choice, because offshore funding is all totally cut. And if you you may not be even able to refinance any of your offshore loans. So that's why they have to be a bit conservative. But the good thing for property, at least for them, I think is number one, 2 of their launches was fully sold out within 1 day. One is I think Nanjing and Jinan. I think I'm not even sure where these places are, but it's starting to recover. Number one, and number two, a lot of the competitors are, the balance sheet, especially the private developers. I think no private developer balance sheet has been able to sustain as well as them. I don't have the data, but you can see all the bankruptcies out there. What is left now is the state-owned enterprises. So, so that's the 4th point. The 5th point is that what can stimulate it is just that there's still a lot of home purchase restriction, although they've lightened it up a bit, but it's in the very 3rd tier, 4th tier cities. So the developers are still very disappointed. There's not enough of loosening of relaxation, even though interest rates are low. So the good thing for Yanlong, I think, is that there's a consolidation happening. The competitors are all kind of knocked out, or at least limping halfway. So that's why they have to conserve the balance sheet, and then when things are better, they can resume growth. So there is a bottoming out phase now. We think at least they had 2 launches that did exceptionally well. Prospects for China aviation. Yeah, we still like it as just a proxy to outbound traffic. It's outbound travel from the Shanghai Pudong. Yeah, I think they mentioned this before. For Ukraine dam crisis, what's the impact on commodity prices? Sorry, I'm not familiar. I didn't even know there was a Ukraine dam. I'm not sure if it's going to make any difference. There's already kind of rockets flying around. Not sure if the dam crisis would make any difference for commodities. Yeah. Again, I'm not so sure what's the impact. Sorry, I missed the news. You want to take on this LLB? I think these are the lithium producers. I'm not sure if you have a view on it. John, yeah. But just to go back on the STI thing, I think the positive spots will be, of course, banks we think consolidate, but the positive spots will be number one, REITs, because we think interest rates kind of peaked out, and then they will benefit them, and they are more defensive. And all those China-related stocks, I think the recovery will still be there. I think, especially for consumer. After all, last year was a shutdown year, so that's one of the reasons why we also initiated on Sasio REIT, because at least by default, last year there were almost 1 month of shutdown. So this year there's only going to be a rebound, and they have like a base dividend yield of 5%. Would you comment on Hoppa? It's been a good cash position, net margin. Yeah, so sorry, I'm not familiar. I'm not sure if Peggy got anything, but sorry, I'm not totally not familiar on Hoppa. We need time. Sometimes we need time to kind of look at these stocks. Yeah. Oh, sorry, was this supposed to be 11? Yeah, we changed it. Our morning webinar, I'm looking at the chat. We changed our event to 11 a.m. because 11:15, there were many complaints because Zoom doesn't allow 11:15 reminders. So a lot of people came in at 11. So that's why we permanently changed our event to 11 a.m. Apologies if some of you didn't. Yeah, this is not 11 to 12. We normally take it from 11 to 1. Usually now it's technical, but now that there isn't any, I think we can kind of end it. Paul, you mentioned Sasio REIT has a base yield of 5%. Where is it from? Miao, you want to explain why there's a base yield of 5%? The upside is from the tenant sales.
Yeah, hi, I'll take this question. of course, Cesare has a very strong sponsor, so they actually get the fixed component from the EMA rental income. From the FY22 data, is 70% of the rental income is the fixed component, which roughly translates to dividend yield of 5.4%.
Yeah, okay. So the way the rent is structured is that, of course, you can call it income support or whatever, but because the SGX wanted it, because otherwise the subsidiary will be 100% dependent on tenant sales. I mean, for me, I don't mind. I want the growth, but because when they came out for listing, because you need some base level of income. So because of that, they fixed it at they gave them a level like I mentioned by Mel. If you work it backwards, there's at least a minimum support of 5% dividend yield. Of course, the test is whether is this artificial. This is not. I mean, the tenant sales, when they take a share of tenants, it's always above it. So they normally earn more than that. But because when you come up for IPO, you cannot be 100% rely on tenant sales. I think the SGX didn't allow it because then REIT usually you need some stability. So of course, depends how some view it. The most skeptical will view it as income support, but the tenant sales more than cover it historically. So that's why we are not so worried about it. It's not like a outright supporting it, even though tenant sales was zero, you still paid. Then that is a bit more financial engineering. So that's why we didn't think that. Yeah. Oh, okay. I'll leave it to John then before we.
Yeah, thanks, Paul. So I'll try to answer this question on Albemarle and Enphase. Sorry, we don't cover any of these companies, but one is for lithium and Enphase, I believe, is for solar energy. In terms of lithium, I guess in terms of the lithium industry, you've got big tailwinds because of the emergence of your EVs, right? So lithium battery is a main component, and when listening to I guess some of the big players like Tesla, and I'll talk about lithium mining and refining, there doesn't seem to be an issue with mining it. So the demand is still strong and the capabilities are still there. The issue and the bottleneck actually comes from refining lithium. And so a lot of you see a lot of smaller players get into the lithium refining business. But even some of the EVs start to refine their own lithium because they can't always rely on someone else doing it for them. And they also are trying to just speed up the process so that they have more of the raw materials for turn into usable products. Unfortunately, I can't give you any more specific information on that. But as a whole, in the lithium industry seems to be moving in a good direction. Moving into Enphase, solar energy. I just read a report here that actually for the first quarter of last year, solar energy saw the largest growth out of any first quarter in its history. So solar energy usage grew about 47% year on year, I believe. Most of it came from like utility related production projects, and then the rest came from residential. So when you look at solar energy and all these kind of alternative energies, it seems like because of the scarcity of the traditional energy like coal and fossil fuels and all that, and how the world is actually transitioning, a lot of governments are transitioning their policies towards promoting alternative clean energy. You could see this as some sort of tailwinds for like macro tailwinds for the industry. Obviously, Enphase is quite well known in the solar industry, and I believe they are one of the largest, so they should be well positioned to capture a lot of this growth. Yeah, I mean, so I guess just to summarize, both these industries are definitely not sunset industries. They're industries that have been more and more in the limelight now, especially with climate change and all that being and ESG being at the top of a lot of politicians' agenda. They're definitely going to be pushing a lot of these alternate energy sources. So hope that answers your questions on these two. I apologize, I can't give you any more specifics because we don't really cover that, go into detail with that. So I guess with that, maybe I'll just end off the webinar right here. I just want to thank everyone for joining us. Unfortunately, Zane isn't here this week, but if you do have any more questions, any TA questions or any other fundamental questions, please post it in our community page and we'll try to get back to you as soon as possible. Hope you guys have a good week and see you guys again in our next Monday's webinar. Take care. Bye-bye.
Thank you, everyone.